So we are now in episode 5. So in episode 5, we're going to dive deeper into high probability. Now, high probability setups are so important within your trading plan. You want to make sure you've got that ratio right of 80-20. If 80% of your trades are high probability and 20 are valid, then you know you're moving into the right direction. Now, you have to understand that it doesn't have to be exactly 80-20, but the whole goal is to move towards that ratio. Now, you might be someone that's at 50-50 at the moment and doing the break-even dance, moving towards a few percent profit. You might be someone that's in the minus. But the more and more you can move towards 60-40, 60% high probability, 40% valid, then 70-30, etc. The closer you're getting towards that ratio is going to increase your chances of becoming consistent. See, the truth is the majority of times why people fail to break through to consistency is they're just taking way too many average trades. And it's not normally these big tweaks. It's these subtle, little, obvious sometimes, little 1% tweaks. So I'm looking forward to diving into them. Let's get started with high probability setups. So starting off here with Kiwi CAD, we're going to start off here on a daily and take you through this high probability setup. One thing that I want you all to note down, this is very, very important. Be careful about ranking your trades. So what I mean by that is that we can get so caught up into this is an A+ setup or this is a B-, etc., when a lot of them can just lead to confusion because they're very, very similar. The reason why we use high probability versus valid is it's very simple, but you can't look at it as black and white because there is truth in the fact that you could take a trade like this, for example, that could be high probability or it could be a valid trade. Now, sometimes there are valid trades that are a slightly higher quality than others based off of the higher time frame structure. So be a bit lenient with that. There always is going to be an element of discretion, not too much, but just a tiny bit. And the truth is, as a trader, you're not going to find this black box system where it's just pure, this, when this happens, you do this. It's not always like that. The market's always evolving, so it's important that we evolve with it and understand how to deal with that. And we can keep it more simple than you think, so let's take a look at that. So New Zealand CAD here, high probability setup. We have this on the daily chart. We're looking at this structure. So what makes this high probability? Well, we're looking at it at the outer structure, and we can see that we've had this overall double top type formation. What makes it high probability in this area is not just because it's a double top, it's because of how it approaches the double top. So you can see here quite clearly on the daily, we actually have this 1, 2, 3. We have this ascending formation. So the great thing is we have ascending nature leading up to the double top. We previously, which is really important to note, is that we had this as well. So previously, if we remove price, you can actually see that this was giving us this. We had this move down and we had a continuation. Impulse, correction, continuation. So we was expecting this to come to the downside. Now there is a type of pattern that's not very common, but when it happens, it gives us a good edge, in which it creates this M-type formation. Some of you remember me going over on Kiwi Yen, me covering this pattern. It creates this M-style pattern and then trickles its way down. Now, let's take a look at it in a bit more detail. So as we move a bit further, we move up, we realize that it's an extension of the pattern, and then we form this structure. So if we dive in a little bit deeper on the lower time frames, let's go to the 4-hour, and we look at that structure. Then we look at this piece of its own. So we pop the ray line on firstly. We've got this high here. As you notice, we just break the high, which is perfect. This makes it even more high probability. Why? Because the mass psychology. We're getting people caught on the wrong side of the market. We then take our trend line and we look at this ascending formation, a very typical pattern that we focus on. And what's the key things that we're looking out for? Well, essentially we have 1, 2, 3. We also have impulse, correction, and the move up, and the middle section. So we have a completion of a pattern, and we rise in the form of an ascending channel that just breaks the high. This is all of the ingredients that we need for a successful high probability trade. Now, you're not always going to get them picture perfect like this, but when they happen, these are the ones that you take over and over again. This must be in your plan. And if it isn't already, I'd highly recommend that you put this in your trading plan when you see setups like this. This is a great example of that. If we move to the 1 hour, it gets even clearer. So on the 1 hour chart, we have a few bits of opportunity to get involved in this. So of course, you can get in at the outer structure, ascending nature, very simple, or you ended up getting in with these corrections before we had the drop. So just a very, very key setup, high probability, outer structure, as you can see with the retrace there. The important thing that I want you to take away from this is this. Stop always waiting for the perfect candle shape formation. So you could look at something like this and say, well, let's have a look. It's moving up. We have the correction here. We have a tiny little correction here, which could be the start of an ascending channel. As we move up, you can say it's quite impulsive there. I'm not too sure about that. Okay, let's move up a little bit more. When do I put the entry on? Do I put it on now? Do I wait a little bit longer? When do I put the entry on? Well, the entry is good whenever. You're in this area, it's corrective. So at this point, as long as your stop is above here, that's absolutely fine. If you get taken in and then it goes a little bit higher, then it comes with the territory. What more do you want? You have to ask yourself, you're already at the top of the structure. You have a 1, 2, 3 right here. 1, 2, 3, and we've just broken that, so you can see this section here. 1, 2, 3, we've just broken the high, and at this point, we're right at the outer structure. So waiting for perfect candle shape formation, waiting for a evening star, for example, isn't always the case, and that's where you can miss out on great opportunities. So at this stage, we've got the corrective nature that we've got at this stage, so I'm happy to put an entry on. High probability area, and then how long after? 1, 2, 3, 4, 5, 6. It just trickles around for a bit. As you can see, it gives you enough opportunity to get involved in the market, and then we start to trickle our way down, and then we drop. So very, very important to understand that when it's in that area, don't get so focused on candle shape formation. Understand that it's already in a high probability state, and you can put the entry on within that area as long as it's corrective or we've got some form of retracement. That's a good little tip there. Now, following on with that, with high probability, I think what we do is we get confused with high probability and think that high probability trades are only trades that are at the top or the bottom of a structure. Now, that's not necessarily true. It's more to do with in the direction of the higher time frame. So what I mean by that is this. High probability, that's a no-brainer. It's at the top of that structure there. But at the edge of patterns or the completion of patterns in line with the high time frame structure is also high probability. So let's take this for example. As we extend, we've had the impulse down. Now we're looking for continuation. So what do we get? We're looking for a flag. So we start to form. And this now starts to form a running channel. As we move up, as you can see here, we've got this type of formation. So we'd be tracking this like so. So you could argue, well, this has got a slight descent to it. It's got more of a descending channel type feel to it, and that's true. But where did it come from? Impulse. It's in the state of continuation. It's in line with a higher time frame. So what makes it high probability then? We've got the high time frames on our side. We've got our first impulse, and this is our first correction after the impulse, which we know is the highest probability. The first correction after the impulse. So at this stage, we start to create the running channel here. So we get our angle. Got on more of our descending channel. So at this stage here, you can filter this on the 15-minute as well. I know quite a lot of you took this one here. So some of you might have an entry on just below this, just in case it drops. As we play out a little bit higher, then we drop from here. So it just pierces through here. And what would have helped is pattern separation. So this is why pattern separation is so key, because as it correctively moves up, it essentially breaks through the trend line, as you can see there. But if you're filtering that out and you can see it for what it is, you can have your entry just below like this, and it becomes a running channel. But it's about evolving with the market and understanding when that happens. But it's a clear ascending channel. Now, if I remove that like so, and we use a bit of pattern separation, this helps with identifying high probability setups like so, then what is it? Well, you can just see it's an impulse, an ascending channel, a drop. It's in line with the impulse, correction, continuation. It's just about looking at those finer details and utilizing the 15-minute to filter it out. So if I go to the 15 minutes and we play it back, this is very, very important. Rather than looking for high probability trades on the 15 minutes, find them on the 1 hour and then utilize the 15-minute to filter it. So at this stage, this is what you would have been seeing. You would have seen price go from here, like so. Let's take this back. As we take this back here, we extend this trend line, and we would be moving up. We'd be expecting maybe a rejection here, and we move above. So as we move above, you can have the little trend line on here just in case. And we move slightly above, and then we start to get the retraces there. So at this stage, we've got the angle, we've got a trend line on there. it could break at any point. So it's fine to set the entry, and you can have your stop just above this high here, just as a bit of protection. So again, got an entry here, stop above there, 30 pips to be on the safe side. And if it goes a little bit higher, you might be able to move your entry up. So where do we get? Goes a little bit higher. And eventually you might have been tagged in a bit earlier, stayed in the trade, but again, just have it above the high, and then you're in the trade. So this makes it high probability, not just because it's a running channel, it's because it's in line with the high time frame structure. And I think that's important to note that as we just start to play out there. And it turns into be a fantastic trade. But overall, it's purely because it's the higher time frame structure. That's the key thing I want you to take away from it, rather than just thinking that high probability trades are here, and then that's it. They are within the structures as well. But the key lesson is it in line? That's the question you want to ask yourself. Is it in line with the high time frame structure? So I hope that helps. Let's take a look at the next example. So moving on to the next example, we now have Euro Kiwi. So what makes this high probability? Well, essentially the first example that I showed you within the previous episode of valid trades, it's a valid trade, but it's moving more towards high probability. Why? Because we do have a lot of confidence within these areas. So like I said, you can't just look at it at black and white. So ranking them A, B, C, or D doesn't necessarily work, but they can be better quality versions of, valid trades and high probability trades. So if we take a look at this and we go to the lower time frame, we can see where we are within the structure here. On the 1 hour chart, if we're looking at this trade here, this is a prime example of a trade that you actually want in your plan, but one that didn't work out. And I think this is a very important example for you all, because this is a type of trade that I'll take over and over again, because I'm thinking in probabilities, right? This is one that I took for a loss. There's two ways you could have taken this one. And this does move more towards high probability. The reason why is because what would have made it even more high probability if you took the same structure and put it here, right? If it just broke this high here, that would of course made it a little bit more. But it is a double top type formation. It's moved up correctively. It has filled that wick, and it has a 1, 2, 3. It has a middle section, it has an ascending channel, a retrace candle. It has all of the ingredients, and you cannot let that one impulse candle put you off in that sense. But there's two ways to take it. You could have waited for 6 to 8 1 hour candles for this ascending channel and then set your entry below, and you just would have never been triggered in. Or you can take it risk entry within the pattern like myself, and that's more suited to my style, and then that way I got taken out for a loss. It is what it is, that's fine. So those are the ways that you can take it, but I think it's important to identify this one as more towards the high probability, because it's a setup that didn't work out. But if you took that 10 times, then you can find those examples and see that 8 times out of 10 that's going to play out within your favor. So taking 2 1% losses, is that going to be a big difference? If, let's say, the other 8 you took an average 2 to 1, just an average of 2 to 1, right? You know, 2 times 8, 16. So you're looking at 16%. Take away the 2 that you lost, you're at net 14%. Right, that's just basic. But as you can tell, it's understanding those differences. So that moves more towards high probability. What makes it more high probability? Well, this next setup. So again, this was the 1% loss, and then I banked 5% on it, so a net 4%. And as we move up here, right there, so the double top. So essentially, we're tracking this trade here. Now, ideally, when we're looking at something like this, it's very, very close towards the outer structure, right? So let's just focus on this pattern. What do we have? Well, we're looking at this as 1, 2, 3. Now, we know it doesn't need to be perfect, but we're at the top of this structure now, this bigger double top. So essentially, what is the override? Now, you remember the override that I spoke about in the previous quick tips. The override is there. We can have a double top and a rejection. And if we're taking the trade there, and we've got to stop just above, whether it's 25 or 30, that's fine. 25 is more than enough. And we've got to stop above there like so, taking the trade. At this point, you could be tagged in and it could go a little bit higher. So you have to use your initiative in these situations and say, right, if I take this trade, let's be a bit more accurate. If I take this trade, where do I want to take it? Do I always want to wait for perfection? Is it suddenly a valid trade now because I'm taking it here? No, it's a high probability. It's in a high probability area. You've got all of the ingredients. It's an extension off of this trade, just goes a little bit higher in the form of an ascending channel. We've got to retrace there. That's fine. Perfect. Put the trade on. And then 1, 2, gives you a little bit of time. And eventually we start to play out, as you can see, right? So it's just about understanding those areas. Yes, the highest probability areas, of course, is always going to be the outer structures. But of course, it doesn't always have to be there. It's completions of patterns as well. But I think this is a prime example of something where you'd have a 1, 2, and if I zoom in, you'd literally only be waiting for this to maybe break above like this and then retrace when it's waiting for perfection again. So there's a fine line between that, and you have to be able to use your initiative and use a bit of discretion. This is what I would call a tiny bit of discretion. Really, it's just the override, because you just put a double top in, and it's the probable and the possible. It goes back to those simple concepts, right? Probable is 1, 2, 3. What's the possible? Possible is we get a double top within there, and we put our stop just above, whether it's 25 or 30 pips, depending on, you know, how aggressive you want to be. That's depending on your personality. You're in a great trade. Literally, keep it as simple as possible, guys and girls. So I hope that helps. First example being one that I would put in your plan over and over again. It's one that didn't work out, but probability is going to work out for you. And the next one, of course, is more of a high probability, because it is at that outer structure, double top type formation with an ascending channel. Very, very important. Big difference between, look at how impulsive this is, moving to the upside, which could still retrace, by the way, compared to something like this. Very, very important. Let's move on to the next example. So here we have pound Australian dollar. So we're looking at high probability setup. What makes this the high probability setup? Well, we have the overall bigger expanding formation. Now you're probably noticing a trend here. I've been talking about it. It always links to the higher time frame. Whether it's here or within a pattern, it always links in alignment with the higher time frame. So what do we have here? We have the bigger double top. So this is a trade that I think could be overlooked quite easily, just because there was a little bit of an impulse. As you can see on the Oanda data here, this doesn't have the gap, but on different data we had a bit of a gap, and it's important that you don't get put off by that. But you can see we've got the probable and the possible. Now there would be areas a little bit lower down that could reject, that we could have more valid trades. This moves more towards high probability, because what do we have? We have 1, 2, and then we're looking at this outer structure here. But at the same time, you know, we could argue that we could move this in like so. It's very, very close. Let's get this angle right. Very close to the outer structure. And this double top is very, very close to that outer structure. So we're at that high probability area, right? It's about not being too perfect. Now if we go to the 1 hour chart, you can see the gap on here actually. So as you can see the gap on here, let's get this exact. So we just pierce through. We get the gap in the charts, and this is where you can be put off. But you have to visualize it like this. You can't let one impulse candle put you off here. And again, if this was just candle shape formation, like so, would it still be a trade? Where you just see an ascending channel that just broke the high at the outer structure. Now some people might look at that and think, is that a trade is that just the fear of missing out? The fear of missing out would be taking it here, because you're worried about not getting the trade. We're at the double top. We're literally at the outer structure. Apart, the only thing that would make this even better if it was just a tiny bit higher. But again, that's perfection, where we've already got the double top that we've just broken, and then the retrace. I didn't end up getting this one just because I wasn't by the charts. I think this is a little bit early. This one, yeah, this was a bit too early. But again, the retrace there, very, very nice. And you just got to visualize. You got to read between the lines. You can go to the 15-minute chart just to filter that a little bit more, so we can see here. So you can filter that a little bit more, like so. And then you have this here. So it gives you a bit of structure. We also have that little ascending channel on the 15, but just to be too particular, the little ascending channel, the move down, the little bit of the hover, the truth of it is, it's more to do with the area that it's in rather than looking at these tiny little details. And of course, the 1 hour chart with the retrace is a perfect area to take. So really a high probability setup that could put people off. And I did want to show this example because people get put off by gaps an awful lot, but you got to look at the area that it's in. And again, taking that on the retrace, even if you just took it as a simple retrace, just above the high, slightly bigger stop, you know, call it 60 for argument's sake, 60 pips, and then so on, however you would have managed it. But of course, as you can see, we're playing out with a higher time frame structure overall. And then it moves on to the next example, which is the first scaling. What you want to make sure that you have in your plans, and I really want you to take this tip away from it, you should always write in your plans, in your descriptions, the first correction after the first impulse is the highest probability of flags. So when you're looking at something like this, right, you're looking at this flag that you probably would have filtered on the 15-minute as well, but you can see the overall correction. Now, waiting for perfection, would be for maybe something else, a tiny rejection here. But again, taking reduced risk entry with the tight flags are always a good sign. If you're taking this probably with a slightly bigger stop, I never really go over 50, very rarely. I'm more towards the lower end of it. But if the higher time frame structure's there, then you're looking at a target of this. It's all relative to the risk to reward, and on the pound pairs, sometimes you do have to have a slightly bigger stop, and that's fine, especially on things like pound CAD, pound Aussie, etc., and pound yen. But again, going to the 15-minute chart, we could filter that a little bit further and then ask ourselves, does it meet the criteria? Does it have all of the sections? The 15-minute can often be used as a filter to look at the bottom of the trend line. So what I mean by that, if I take this back to around here, as you can see, you can clearly see that we do have those sections as 1, 2, 3. We've got a bit of structure to the flag. You can either look for risk entry or have a reduced risk entry just in case, because the high time frame can just impulsively play out and we have such a bigger move to the downside. So just something and a quick tip for you to put down is that when we're at the high time frame structure, after we get the first impulse and then we get the first correction, that is the highest probability setup that I can take in terms of these tighter, reduced risk flags. And also, one just quick tip to note on pound Aussie is with this particular structure is that in this scenario, you might have been someone that took this trade and you may have taken a 1% loss. It may have spiked you out, right? And it's easy in this type of situation to say, what did I do wrong? But the truth is, you didn't do anything wrong. This is purely probabilities playing out. If you took this same setup 10 times, 8 out of 10 times it's going to play out. Why? Because we're at the top of the structure, we've had the first impulse, and you're taking the first correction. So this is actually a good example because it would be so easy in that type of formation to say, well, I've got the first impulse, I've got the correction, I took that, and this one spiked me out for a loss. What did I do wrong? Absolutely nothing. As long as you stuck to your plan, that is the most important thing. And just remember, it's probabilities playing out. So that is it for pound Oz. Let's take a look at the next position. So this last position I want to run through is Aussie dollar. So Aussie dollar, as you can see here, we have this overall trend line, this 1, 2, looking for the third touch, and then we start to get this ascending channel. Now we know that we could fill this wick and move to the downside to create this overall structure here, which we have 1, 2, looking for this move to the downside for then the longer term move to the upside. So it does have a bit of structure and a probability to play out. Now you can see we have this 1, 2, 3, we have this kind of middle section within here that you can see in the lower time frames. If I go to the 4-hour chart, so the 4-hour chart here, if we dissect that, I know a lot of you guys and girls took this trade as well. So you can see the middle section. It's very clear that we have the move up, the correction in the middle, and then the move up, which happens to be an ascending channel, which is perfect. A little double top within there, some retraces, playing the 90% rule. So this isn't at the top of a structure, if you like. It's not at a big double top or anything like that. But this is another example of a trade that is high probability because you're playing the pattern. It's a high probability pattern in alignment with completing this move to the downside. It has a lot of room to move to the downside, so that still makes sense for us to fill this wick. So you can't look at things just in black and white, and it's not always going to be picture perfect. So I thought this was a great example to show you all. And when you look at it in a bit more detail, we go to the 1-hour chart here. What makes it high probability? Well, you can see the overall structure here, and this would be a great example of when you'd be looking at this trade. Let's say from here, what would you be forecasting? Well, you'd have your ray line on like so. Ideally, you'd want to be at the outer structures, but you'd be looking for something like this, an ascending channel, looking to break to the downside like so, right? Or getting some sort of rejection. Now, as we start to move up, we get that rejection there. So at this point, we've got a bit of a rejection on this wick. Then we can start to put our trend line from our second one here and actually match it to something, because we don't know at this point, right? We could be aiming for this outer structure here. But after we get the rejection, we can actually have this parallel trend line on. And as you can see, parallel to the structure, when we have these patterns, this trend line here, which you can just clone it, is normally parallel to this structure, which it is here. As you can see, we've got the ascending channel. We just break in the double top. And then on the 1-hour chart, we start to get that retrace and that ascending channel, which you can filter on the 15-minute as well. So putting your entry on the break and your stop above the high, let's say 25 or 30. Let's say 25 for argument's sake. So you've got it there on the break. And then as we play out to the downside, then we get a correction here which just hovers and you get a bit of a spiking there. And this is a great example with a bit of management as well. Until we break in, you've got to use a little bit of discretion. Essentially, you could move to break even. Technically, it did just get to 1%, so you could have moved that to break even, but it hasn't really moved anywhere. It hasn't even broken out of the structure. So you have to utilize your initiative in these type of structures and let it actually close below this structure and commit before you start locking in profit and moving it to break even. If there was ever a way to not move it to break even so quickly, it's at the top of these structures with high probability. If it was just a typical, impulse type flag like this, and then an impulse down, and then it retraces, of course you take a break even because that can develop into a bigger structure. But at this stage, a little tip there as well from a management perspective would be to let that breathe rather than just do that, because it can just trickle its way back as well. So worst case scenario, what do you take? You take a 1% loss. It's not a big deal. And then eventually we play out for the 90% rule. We get a few corrections along here as well. Again, remember the first flag is always a high probability that we take, especially when we're playing the 90% rule to the downside as well. And then we start to get a correction there. It's not the cleanest, but we do get these little tiny flags here. Remember these? And then we just keep playing out to the downside. So it's just about understanding that a lot of times when we get to 90% rule is when we create more of these descending structures and we start to pull back as well. But again, just noticing that not everything's black and white, and you have to read between the lines and utilize your discretion in that sense, but not too much. We're talking a tiny part. Discretion should only really be 5 to 10% of your game, which comes with a bit of experience as well. And all of the consistent, successful traders in the community understand this process. So try not to avoid that and understand it comes with a little bit of time. So with the high probability setups and the valid setups, I hope you can see the difference here, that with valid setups, it's more to do with the probable and the possible, and realize that, it can play out, but high probability is normally at completion of patterns, top and the bottom of structures as well. They're always really good and in alignment with the higher time frame structure. That's really what I want you to take away from it, and realize that when you can get your ratios right, like I said at the beginning, moving towards that, I promise you, just by some of these things might seem obvious, but I encourage you to go over your trades. So a great exercise for you is to go over your last 10 trades, just like I mentioned in the previous episode. Go over your last 10 trades and sometimes even more, and tally on how many are high probability, how many are valid, right? So we can see those ratios. And what I'd love for you to do is actually find 3 examples of each valid and find 3 examples of high probability. And what I want you to do is I want you to annotate on the charts why it's high probability. Annotate on the charts why it's high probability, and annotate on the charts why a particular trade is valid. So just bullet point them with text, just do the call out, annotate it on the charts, and of course feel free to share that within the community as well. So we've got that engagement throughout. Everybody's happy to help out. I'm happy to comment on them as well. Share them within the community, share them in the general chat or in questions, so then we can see that, because it's a great exercise for you to not just watch this episode and say, okay, that makes sense. Actually do it. Go and find 3 examples of high probability and then write the reasons why you believe that is high probability, and as a community we'll help you out. And that's going to help you move forward. And that way, the 1% tweaks you make from this episode is going to make a humongous, I honestly believe with these 2 episodes alone, is going to make the biggest difference to your performance. Sometimes the biggest 1% tweak can be this little difference here. So I hope you took a lot of value from these episodes, and I cannot wait to see the progression that you will make. I'll speak to you all soon, guys and gals.